Investing is one of the best ways to build long-term wealth and financial security. However, even the most seasoned investors can make costly mistakes that jeopardize their hard-earned money. In this video, we'll explore 7 critical investing mistakes that can potentially cost you millions of dollars over time. Avoiding these pitfalls can mean the difference between achieving your financial goals or falling short. So, buckle up and get ready to learn valuable lessons that could save you a fortune in the long run. Mistake number 1: lack of diversification. One of the most fundamental rules of investing is diversification. Yet it's a principle that many investors overlook or fail to fully embrace. Putting all your eggs in one basket, whether it's a single stock, sector, or asset class, exposes you to an excessive amount of risk. If that investment performs poorly, your entire portfolio takes a major hit. Diversification, on the other hand, helps mitigate risk by spreading your investments across different asset classes, sectors, and geographical regions. When one investment zigs, another may zag, offsetting losses and providing balance to your portfolio. Legendary investor Warren Buffett once said, "Diversification is a protection against ignorance." It makes very little sense for those who know what they're doing. However, for most individual investors, diversification is essential for managing risk and achieving long-term growth. Mistake number 2: trying to time the market. Timing the market, the alluring yet elusive idea of buying at the bottom and selling at the top, is a trap that has ensnared countless investors. While it may seem like a surefire way to maximize profits, the reality is that successfully timing the market is incredibly difficult, even for professional investors with teams of analysts at their disposal. Market movements are largely unpredictable and driven by a complex interplay of economic, political, and social factors. Attempting to outsmart the market often leads to impulsive buying and selling decisions that can significantly undermine your long-term investment strategy. Historically, the most successful investors have embraced a buy-and-hold approach, staying invested through market fluctuations and benefiting from the long-term upward trend of the markets. As the famous investor Peter Lynch once said, "Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves." Mistake number 3: panic selling. When the markets take a tumble, it's natural to feel a sense of fear and anxiety about your investments. However, panic selling, the knee-jerk reaction of offloading investments during periods of market volatility, is a surefire way to lock in losses and jeopardize your long-term financial goals. Market downturns are an inevitable part of the investment cycle, and history has shown that they are typically followed by periods of recovery and growth. By selling during these downturns, you not only solidify your losses but also miss out on the subsequent rebound. Successful investors understand that market fluctuations are temporary and that staying the course is often the wisest strategy. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." By maintaining a level-headed approach and sticking to your long-term investment plan, you can weather market storms and position yourself for long-term success. Mistake number 4: ignoring fees. In the world of investing, fees may seem like small, innocuous expenses, but over time, they can have a massive impact on your returns. Investment fees, commissions, and taxes can act as silent wealth-eroding forces, chipping away at your hard-earned gains year after year. Consider this: a 1% annual fee may not seem like much, but over 30 years, it can potentially reduce your investment returns by up to 28%. This means that if you invested $100,000 and earned a 7% annual return, you'd have $761,225 after 30 years with a 0% fee. But with a 1% annual fee, your final balance would be only $543,517, a staggering difference of over $200,000. To combat the corrosive effects of fees, it's essential to be fee-conscious when selecting investments. Opt for low-cost index funds or exchange-traded funds, ETFs, whenever possible, and avoid investments with exorbitant fees or sales charges. By minimizing fees, you can keep more of your returns in your pocket, compounding your wealth over time. Mistake number 5: Failing to rebalance. Rebalancing your portfolio is a crucial yet often overlooked aspect of successful investing. Over time, the allocations in your portfolio can shift due to the varying performance of different asset classes. For example, if your target allocation is 60% stocks and 40% bonds, a strong bull market could skew that mix to 70% stocks and 30% bonds. Failing to rebalance your portfolio periodically means that you're no longer adhering to your original investment plan and risk profile. This can expose you to more risk than you're comfortable with or cause you to miss out on potential gains in underperforming asset classes. Rebalancing involves selling off a portion of your outperforming investments and reinvesting the proceeds into underperforming ones, bringing your portfolio back in line with your target allocations. This disciplined approach not only helps manage risk but also enforces a buy low, sell high mentality that can enhance long-term returns. Mistake number 6. Taking on too much or too little risk. Risk is an inherent part of investing, and finding the right balance is crucial for achieving your financial goals. Taking on too much risk can expose you to excessive volatility and potential losses, while taking on too little risk may hinder your ability to generate meaningful returns. Determining the appropriate level of risk for your portfolio involves carefully evaluating your investment objectives, time horizon, and risk tolerance. Younger investors with longer time horizons may be able to take on more risk, as they have more time to recover from potential losses. Conversely, those nearing retirement or with more conservative goals may want to prioritize capital preservation over aggressive growth. It's essential to periodically reassess your risk profile as your circumstances change. Failing to adjust your risk exposure can lead to a portfolio that is misaligned with your goals, potentially resulting in suboptimal returns or unnecessary volatility. Mistake number 7. Emotional biases. Investing is not just a numbers game. It's also a battle against our own emotional biases. Greed, fear, overconfidence, and herd mentality are just a few of the psychological traps that can lead even the most rational investors astray. For example, the fear of missing out, FOMO, can cause investors to chase hot stocks or trends, buying at inflated prices and potentially setting themselves up for disappointment. Overconfidence, on the other hand, can lead to excessive risk-taking and a false sense of invincibility. Successful investors understand the power of their own emotions and strive to make decisions based on objective analysis and sound investing principles. Maintaining a disciplined approach, setting clear goals, and adhering to a well-defined investment strategy can help mitigate the impact of emotional biases and prevent costly mistakes. Investing is a journey filled with potential pitfalls, but by being aware of these 7 critical mistakes, you can significantly increase your chances of long-term success. Remember, building wealth through investing is a marathon, not a sprint, and avoiding these mistakes can mean the difference between achieving your financial goals or falling short. Embrace diversification, stay the course, manage fees and risk, and keep your emotions in check. By doing so, you'll be well on your way to creating a secure financial future and potentially saving yourself millions in the process.